And now we're going to explore all the different components that make up a complete trading strategy. And we're going to start with the entry. The entry basically says, how do we get into a trade? What signals a good trading opportunity to begin with? When do we buy? When do we sell? That's the first step. And when we look at entries, we can define it as a set of rules or conditions that determine your trade execution. So pretty much, what are the conditions on your charts that need to be met that signal for you now is a good time to buy versus when is a good time to sell, or when is a good time to do nothing because the charts don't have any favorable conditions. And a good trading signal is a trading opportunity where one thing is a little bit more likely to happen over another. For example, if we build a trading strategy, what we want to have is we want to have a set of rules, criteria, decisions that help us find buying opportunities, and those buying opportunities based on the data that we have collected, the backtesting, the trading data shows us that now is a good time to buy because based on what we've seen in the past, in history, now the market has a higher chance to go up, and that signals then a good buying opportunity. And when we look at the entry types, we can distinguish between pending and market and breakout and pullback orders. And we're going to look at all of them now. First of all, we're going to focus on what is a pending versus what is a market order. And there's a huge but very obvious difference between pending and market orders. And with a pending entry, you can place your trade entry at a predetermined price level, and then your broker will automatically get you into the trade when the price is at that level. So when we look at a chart, it becomes very clear right away. So we look at this chart, the price currently is here at this red line. This is where price is right now. And if we want to get into a trade here, we could say right now that we put a pending order at this level, 0.70450. And we can place our pending buy order here, even though the price is not there yet. And what happens is that we can close our trading platform. We can even shut off our trading computer, and our broker will automatically convert the pending order into an actual buy order if or when the price gets here. So if the market turns around and if it hits this level here where our pending order is, this will automatically be executed as a buying trade. So a pending order, you can set it anywhere. You can set the pending order higher or lower than price action where you're currently at, and then you just have to wait. You don't even need to be in front of your charts. The broker will do everything automatically. You just put your pending order wherever you feel you want to get into a trade, and that's the pending order. On the other hand, with a market order, your trade is entered immediately at the current price area as soon as you hit buy or sell. So if you want to trade with a market order, either you have to wait for the price to get above this level, and only if the actual price is moving higher and getting here, then you can get into a market order if you want to trade here. Or alternatively, you can only execute right now where the price is. So if you pull up this chart at this moment, you only can get into a market order right now here. So if you want to trade with a market order, it always happens at the price where the price currently is at right now. Versus a pending order, you can set it anywhere, and then if the price gets there, your broker will do this for you. And then the question always comes up, what is better or worse? What should I do? And I've been trading for 15 years. I've been mentoring trader for 10 years, and I've not seen that there is one distinct entry type that is better or over the other. There are, as always, pros and cons, and it does depend a lot on the trader and the situation of the lifestyle. For example, if you have a very busy life, you cannot be in front of your charts all day long, but you can do your analysis in the morning, you can do your chart analysis in the evening, then maybe a pending entry is better for you because you can set up your charts, you can do your analysis, you put your pending orders at levels where you want to trade, and then you don't have to look at the charts anymore. Whereas if you have a lot of time, you can then maybe build a more market order related trading strategy. So your trading strategy where you actually execute the trades with a market order instead of a pending order. And here are some pros and cons. Pending order, usually your entry can be a little bit earlier because, well, you can put your pending order right at the breakout level right here. Whereas if you are working with a market order, you have to watch this chart if you want to trade a breakout, if you want to trade when the market gets above this horizontal level. With a market order, you have to watch it. And it could be that At the moment when the market is breaking out here, you're not in front of your charts and you cannot get into a market order. So sometimes the market order will be a little bit later. Also, a pending order has less confirmation and also less information, because obviously you could now, when the market is here, you could put your pending order here, right? But you don't know how the market is actually going to look like when the price will move here. And what has happened before that, you don't know that. So you have a little bit less information with the pending order. Whereas with the marking order, you know exactly how the chart looks like when you get into the trade, because you need to be in front of the charts to execute the market order. Also, pending orders have a little bit more issues with fake outs, because obviously if you have your pending order here and you have maybe a volatility spike that spikes through the level, you will be in the trade automatically on the pending order, and then maybe it could be the same candle reverses lower and then it looks like a fake out. But there's no way of actually dealing with that on a pending entry level. You just have to accept that with a pending order, the convenience that you have, the earlier entry, the less screen time, there is obviously a trade-off. And the trade-off is that you don't know how the chart is actually going to look like. And there's always the risk that you're going to run into those fake outs. Whereas with a market order, you could just wait for the market to actually close above this level fully and then get into a trade. And lower win rate, higher win rate, over the last few years, I would say this is not the case anymore. Maybe prior, I would say, okay, the pending order had a little bit more of a lower win rate, but I think over the last few years, this has become more or less equal. So you cannot say that there is a huge difference between market and pending orders when it comes to win rate. Although I would still say, based on my trading, the market orders has a little bit more of a higher win rate, because you have less fake outs, you have more confluence, although the trade-off is usually a smaller reward to risk ratio. So again, no right or wrong, and I would just try it out both and see how it feels for you. It also depends a little bit on your personal lifestyle choices. So after the differentiation between market and pending orders, we have to also differentiate between breakout and pullbacks, because that's really pretty much all of the trading strategies can be boiled down to either breakout or pullback approach. And when we talk about a breakout, we are talking about an entry where the market has successfully pushed through some type of breakout level or a tool. And here we are going with the momentum. And when we look at a chart, this is how it would look like. You have your chart situation, you identified maybe the double bottom here, you have your entry or your resistance level here, so support turns into resistance. And then this would be a breakout area. You define that this is your breakout level. It could be a pattern level, it could be a neckline, it could be anything really. It could be a moving average, whatever it could be, whatever it is, but you have something that you have identified that has previously acted as support and resistance. It was a barrier of some sorts in the past, and now you want to see that the market clears such a breakout level. And that is then signaling often a change of market structure. So here you can see the market is pushing through this, and this is what we would call a breakout entry. And you could obviously then, when we remember what we did just 2 minutes ago, we could think about, okay, we want to have a pending order right above this level, or we wait for a candle to fully close and fully break out the level, and that could be your market breakout entry. So that's what a breakout is. You're using some type of tools and concepts that identify a barrier of some sorts, and then you wait for the market to break through it. Whereas a pullback, you're entering when the market is coming back to a specific level. For example, after a bullish breakout, what we've just seen, you're waiting for the market to come back to the breakout area. And it would then look like here. You have your breakout, obviously, then you wait for the market to move away a little bit from the breakout level, and then you're coming back, you're pulling back into the breakout level. And this is then where pullback entries would be initiated. So you are not going with the momentum, whereas here on the breakout, you see the market is going up, then you're going higher. Here, the market is coming down, at least short term. Long term, it still has been going up, but short term, it's going down. And you want to see the market is testing the previous breakout area. And again, it could be anything. It could be a session high low, it could be a round number, it could be anything from a pattern, a neckline, a double top, double bottom, support and resistance, just a swing high or low, any moving average, whatever it is. You could use any of those tools for breakouts or for pullbacks, as we will see later. And again, pros and cons, what is better, what is worse. And I've been trading both for well over 10 years. I've been trading breakouts and pullbacks for well over 10 years. What I've seen is that, again, there's no better or worse. There's no one size fits all. Some traders are really drawn towards pullbacks. Some traders really drawn towards breakouts. So I would encourage you to try both and then see how you feel. A breakout, you're going with the momentum. Because you are sometimes getting in a little bit later, your reward to risk ratio is a little bit smaller. Also, you're often just very soon having to accept a drawdown. What this means is that if you get into the breakout here, you see a little bit of a push and then the corrective wave, then you can see it's moving against your buying opportunity, your buying trade rather. And that is what I was referring to, a drawdown. Because the breakout is usually happening somewhere in the middle of an existing trend wave, and then you are very close to probably the next corrective wave. But you also have more trades with the breakout approach, because sometimes the market is not going to pull back, and sometimes you have a great trading situation, you identified the direction correct, but after a breakout, the market is never pulling back. So you can see here, we have a flag breakout or a triangle, whatever you want to call it, a breakout here. The breakout traders would get in, the pending entry much sooner, the breakout market much later, but the pullback, there was no pullback back into anything here. There was no pullback into the pattern, no pullback into the origin. So the market just moved higher. And that's what I am meaning here. Sometimes there won't be a pullback. And that's the biggest challenge that I am seeing, especially for new pullback traders. You have to wait, you have to do your analysis, you're anticipating the direction correctly, but then after the breakout, there's no pullback. And you see that you could have made money, but there was no signal. And I think that's the biggest hurdle for pullback traders. But if you can get over that, and if you can accept that, okay, my edge, my style is a pullback, and breakouts are just not my thing, after a while you will get used to it and you can be a little bit more okay with that. But this is, I think, the biggest challenge that you will experience as a breakout or pullback trader rather. Here again, we have the inverse head and shoulder. Seems like we're moving higher, corrective wave, lower bounce. You can see the build up here. We have the breakout. Pending orders will have to struggle here with this one as a fake out. So if you have a pending order above this level, probably the spike will get you in, and then you have to sit during this nasty pullback or this retracement. Then the market breakout traders can get in here on the fully closed candle, but afterwards, at least until now, there was no pullback. So again, that's the difference between pullbacks and breakouts. All right, so now we have learned about pending versus market and pullback versus breakout. But actually, what signals a good breakout? What signals a good pullback? And how do we get into a trade? And here we're going to talk about signals and entry signals rather. And in many cases, we can write down the entry criteria or the conditions, and we can turn them into actual observable signals with specific conditions. And that's really what we're going to do further here along the way. For example, we could boil down a trading strategy into a few rules. First of all, we want to see that the price is above the higher time frame moving average. That would signal, okay, we are in a trend overall long term. Then we could wait for a corrective wave, because that's usually a better entry opportunity. Remember what we did with the connectors, with the pattern connectors. We want to see the market pull back a little bit, give us a better price. And then during the corrective wave on the lower time frames, we could look for a breakout into the next impulsive wave. And that could then look something like this, right? We are coming from a downtrend, we roll over. Condition 1, we are above the moving average. Condition 2, we have the corrective wave back into the moving average. Condition 3, we have the breakout into the new trend wave. And we can, as you will see later, boil down or really condense our rules into those lists and then even turn them into checklists, which will help. And in trading, we call such a trading style where you have those conditions that are objectively visible on your charts. We call that non-discretionary or rule-based. I will come back to discretion and the term in a moment. But for now, what we're going to focus on is that we can turn a trading strategy into those criterias and have an entry based on specific conditions. And what really helps me and other traders to think about not only entries, but anything else, as we will see in a moment, is we can turn it into an if-then plan. And that really helps, because we can boil every trading decision down into the if-then. If a condition occurs, then what we're going to do. This is our action. If, for example, the price is below the daily moving average, if also the price is then breaking a support level, and if then there is a retest, then we go into a trade. So you can see those are all the conditions that have to be met before we get into a trade. If, then. Or when we are in a trade, we could say, what is signaling an exit, as we will see. For example, maybe the price is pulling back a little bit more and we are falling back below the last high, and also the market is closing below the 20 SMA. If, then we're going to exit the trade. And that really helps, as you will see later when we come back to creating strategies, or when we look at our actual trading strategies that we can trade here, is that we can boil down any trading decision really, and this is really every trading decision that you're going to do, you can boil it down into this if-then scenario. Something is happening and this signals or is leading to an action. We just have to then define the conditions. What are the conditions and what is the action? And that really, really helps, as you will see. And when we want to create those if-then scenarios, what signals the conditions for an entry? We can really use everything, and there are no limits. Anything is really allowed. We can use patterns, trend lines, moving averages, support and resistance, supply zones, divergences, crossovers. We use higher and lower time frames, trend maturity, wave principles, any indicator, Fibonacci, volume. We can use sessions, candle signals, correlations, gaps. And as you will see later, when we look at the trading strategies, they all use very different combinations of all of those tools. And the good thing about this is then, because we have so many tools, we have so many principles, price action criteria, we have so many indicators, we can combine higher time frames and lower time frames in many different ways. This also means that we can create many, many different trading strategies with all different conditions, and then we can test the different conditions. What is a condition or a set of conditions that work better in certain situations on the markets? And that's really where we're going to see and have a lot of fun when it comes to creating strategies from scratch. We're going to combine all of those different things and see how can we find profitable entries. And really anything is allowed here, and you can really have a trading strategy, and you can have many different trading strategies with many different criteria. And that's really then what we're going to do next. So before we move on to the next video, just a very quick recap what we have done. We've talked about market versus pending orders, and we've talked about breakout versus pullback. And you will be able to put 99, probably almost all trading strategies in some of those categories: market breakouts, pending pullbacks, but pretty much every trading strategy can be characterized by those terms. Also, an entry or any trading decisions is guided by this if-then plan. If a specific condition exists on our charts, then we're going to take actions. And we get into trades when specific conditions are met. So we have multiple if scenarios, for example, the market being in a trend, what is being above a moving average, being below a moving average. Maybe we need a pattern, maybe we need a breakout, we need to pivot at a specific point. And all of those conditions, if they are met, then we're going to take an entry. And that is how we can then boil down entries, as we will see later in our trading strategies.